This is the Domain Magnet Show, where you'll learn everything you need to know about buying, optimizing, and selling online businesses with your host, Michael Bereslavsky.
Welcome to another episode of the Domain Magnet Show. Today we have Richard Patey, a website investor. Hi, Richard.
Hello, very good to be here. Good to speak to you again.
Yeah, so we've been speaking for some time now through your podcast, through other means. I think we've been in touch for a few years now, right?
I think so, yes. Yeah.
And it's been interesting to see and keep tabs on what you've been up to. So give us a quick introduction. Like what is the main thing you're doing now? What have you used to do before?
Main thing right now is a publication on a platform called Substack. It's about website investing, and it's a weekly newsletter and a weekly podcast and some other benefits that has a paid component to it. So that's my main focus. Previously, I was building and selling content sites, and in between those two, I was partnering up with investors as the operator. So I've had experience on selling, acquiring, operating, and now I'm doing a media play covering the industry.
That's pretty cool. So you've done quite a few deals then as well. If you had to guess, like how many sites would you say that you've acquired for yourself, for investors, or consulted for acquiring?
Acquired myself with my own money, 0. I buy age domains and build out on them. So like revenue generating sites is not something that I acquire. It's something that I build and sell. But with investors, like I've consulted and partnered on, a good 3 to 5 acquisitions, and I've operated a few sites outside of that where the investor had already acquired them and was looking for an operational partner. So maybe been on the buy side, actively involved about 5 to 10 times. But in terms of the number of deals that I'm looking at every week, because I run a weekly newsletter for paying subscribers where I curate the best deals that I find across the marketplaces. And so, every week I'm looking at 10, 20, 30 different deals and doing due diligence all the time. So, very familiar with what to look for acquiring revenue generating sites. So I see website investing as 2 different parts now. And the part that interests me the most is what I'm doing, which is building out. So you're acquiring non-revenue generating starter sites or abandoned blogs or age domains that have SEO authority. And you're investing in content primarily, and also a few links as well. So it's mainly, that's what I'm now focused on. And that's the more interesting part for me to personally play in, because I prefer to build and sell sites rather than acquire and put my capital back in that way. So I have a lower risk tolerance, but I'm building up a pretty cool domain portfolio now. Actually, I'm very happy I'm buying like at least 1 domain a day right now, which is kind of funny. But I'm getting more into the domain investing world and seeing what lessons can be learned from that and bring it over to the world of website investing. So that's the answer.
That's pretty cool. So I know that, so we've been discussing that all those different things like on and off and different deals. And I see that you now look at many different deals. So I'm curious to dive into that a little bit more. Is it mostly on the low end, the sites with low revenues, or you also look at some of the higher revenue generating businesses?
For the newsletter that I do for paying subscribers, so it's most of the subscribers are looking for revenue generating websites. They're looking to acquire an asset and get the cash flow immediately from it. So I'd say the majority are interested in that, and average deal size, or the most typical that they would be interested in, would be from 50K to 200K, that kind of mark. I've got a few subscribers that are interested in 7-figure deals. So really, I don't discriminate in terms of the deal size. I like to include, in what I'm looking at and what I feature, I like to include at least 1 age domain that can be built on. And now there's going to be a new segment for starter sites every week. And so if I see a good deal, say on Empire Flippers or Investors Club, that's a 50K asset or a 500K asset, regardless of the asset price, I'm going to feature that if it meets my due diligence and my criteria for featuring a listing. So it can really range. And so I featured, one 7-figure deal before that was on Empire Flippers, I think. So I don't discriminate in terms of keeping the deal size small, but in terms of the greatest number of investors interested, it would be, around probably like 100K asset price would be the most popular deal size for these guys to want to pick up.
So do you follow up later and help people acquire the businesses they're interested in, or do you just introduce them and that's it? Like, do people respond and want your help in facilitating the transaction?
No, so I don't. So previously I was the operator, and I've done consultancy where I would help an investor acquire a deal, and then I would be in place to operate the website. I've stopped all of that, and I'm now focused on a media play. So I'm focused on creating content and curating the best deals that I find. And within the publication, paying subscribers can ask me any questions. There's a discussion thread, but I no longer offer support with an acquisition or with operations. So no, that's in the past.
That's pretty good. And do you still do some consulting if people want, some kind of advice on buying?
I do. I mean, I try and just push everyone to Clarity. So I have a profile on clarity.fm, and you can buy the minute. A number of the more serious paying subscribers are asking for additional help, and I'm kind of putting it back onto them in terms of what support they would look for and how they would price it, because it's not something that I'm looking to offer. And I don't really have any capacity to offer consulting right now. But if enough people want a higher tier, package, the paying subscription is only $49 a month. But if enough people ask me for a higher tier one, then maybe some $4.99 a month offering could happen at some point. But I'm going to have to get people involved before I do that. And I'm now at the point where I'm trying to get. I need to get like a deals analyst on board to support me. I need to get start getting some writers involved as well and help with the podcast, because it's turned into far more than a full-time job, and I can no longer cope by myself. So right now I'm not offering anything like that, but in the future, if it makes sense and I can scale it with a team, then that might be something that I offer, but not right now, no.
That's pretty nice. So it seems like the podcast has done quite well, even though you started that new one quite recently, right? And you've had the previous established podcast, Flipping Websites, which I know became quite popular, and I know that many people really liked that you were so transparent and so open about things that you were doing. So that probably helped you build a substantial community.
Yeah, I already had the audience, which helps. And I mean, I only just syndicated the podcast to iTunes and Spotify. We're now recording on Tuesday. I only did that on Saturday, like this weekend. I just hadn't got around to it. But even so, like, because I built up a personal email list and an audience, I had a good place to start from. And the most popular podcasts were immediately getting 200-300 downloads like immediately, which is may not sound like a lot to people that don't that haven't created a podcast before, but it normally takes like quite some time to get to that level, or get to like 1,000 downloads an episode mark. So with it syndicated, and if I free up some time to now promote the podcast in a way that it deserves, it should get to similar levels as the previous one, flipping websites, and continue to grow. So yeah, I mean, this is the third time I've done a podcast, and everything gets easier. I mean, I've been doing this entrepreneurship thing for a decade now, and things just you follow the path of least resistance long enough, and you can end up in a place where you can get traction pretty quickly.
Yeah, it seems like you're pretty good with podcasting. I could use some tips. I'm curious. Like we've had this podcast now for like a bit less than a year, and we've gotten some traction, but we haven't really been able to grow it that much. What have you found to be like really useful for growing the audience?
Yeah, so with flipping websites, the thing that really grew that, I think, again, because like getting data from podcasting is really hard, but I was able to generate a lot of iTunes reviews because I was giving away free Ahrefs subscriptions. I either had 10 or 20 of those to give away, so that really helped. And so I think that got more exposure. I would assume so in iTunes or whatever the app that Apple has. Well, it's just atrocious, the setup on Apple. So I think that helps to get traction. Yeah, I mean, it's still hard to get discovered. It's still very hard to discovery is still an issue. I've seen stats where in some countries Spotify has now taken over as the most popular app in terms of the number of downloads of episodes or the number of total downloads in some countries is higher with Spotify than iTunes, and I'm certain Spotify is going to overtake Apple like globally within a few years. And so it's far more important to be on Spotify than iTunes now. I really don't care about iTunes. I just, the experience on Apple is just terrible. So, but I mean, I added it there because, I mean, obviously that's the thing to do, and a lot of people still use the podcast app or iTunes or whatever the setup is. I stopped using this a long time ago, but I think that helped get traction with flipping websites. But what really helps is having your own direct relationship with your subscribers, with email subscribers. So having a really engaged list will just drive everything. And that's why being on a platform such as Substack is really great for me, because everything drives everything else. So I have a Monday newsletter where I recap the past week's news for website investing, and so that's going well, and so that attracts more subscribers. And then every Friday is a new podcast episode, and every post you do on Substack, you have the option of emailing it out. So I'm emailing once on Monday with the newsletter and once on Friday with the podcast. So every email subscriber gets the podcast delivered to their inbox. And then within Substack, you can actually click on the audio file and you can play it on the web browser immediately. So being in a platform where everything can benefit everything else is very, is a very useful thing. So my newsletter subscribers is driving the podcast, and now that the podcast is syndicated, that will pull more people into building the newsletter list and guest posting and being on other people's podcasts, and this will drive everything else. So just being able to tie everything together is really useful.
Some pretty good advice. So you've been dealing a lot with first-time buyers, I imagine. What would you say are some of the most common mistakes that they often make? What are some things they should really keep in mind?
Yeah, I think that so I was able to kickstart the publication with the paying subscribers that were interested in the deals with from my existing network, and these guys are repeat buyers. So that was what got me going, like the first 50 paying subscribers. And now on Substack, the new subscribers that I'm getting, I imagine are newer to the space, and they are seeing the newsletter that can get shared on social, because every email is also a web page, and I'm putting some Facebook ad spend behind it. So I think going forward now, these are people new to the space, and so they are, I think, wanting to learn more about what a good deal looks like before they pull the trigger. And where you can get burned is that the major one is by buying a content site that is dropping after a recent Google update. And if you're not aware of being able to spot that within Google Analytics, Maybe the traffic downtrend is hidden because there's been a spike in a different traffic channel. If you're just looking at total page views, maybe things don't look too bad, but if you add a search filter, you can see that there's a big drop. I think that is the main risk, and knowing when a Google update has just happened and trying not to close a deal just afterwards. I think that's where you can get burned the worst, because you don't know whether the asset that you're buying has been affected or not yet. It can sometimes take a few days for a Google update to show up. So yeah, just be careful around Google updates. Although obviously most number of times Google doesn't it doesn't give you advance notice on that. So you just need to be careful that if there has been a Google update and you are involved in acquisition, you need to just see if you can extend that inspection period or hold off before you transfer the money. I think that's the main issue in terms of first-time buyers getting burned by buying a site that was doing $3,000 a month, but 1 month later is now doing $1,000.
Yeah, that's a good point. We see that quite a lot now as well. So every time we consider we buy something, we always have our SEO team generally we look at Google Analytics and Google Console. So the Google Search Console would generally be the easiest, I think, to give you an idea if there is like a sudden drop.
In terms of impressions?
Yeah, in terms of impressions, in terms of rankings, if an update happened, because it might take a few days until it's more official. And also, yeah, looking at HRFs or SEMrush, that could be helpful.
Yeah. So I mean, Ahrefs is my primary tool, and it will show like a drop immediately or within a day or so of a Google updates. But I have been realizing that you can't rely on the extent of the drop the fall or rise that it's showing. It can often be quite out in terms of how severe the update has been for the website. So it's something that I'm no longer relying on. But if I see a trend down in Ahrefs, then it's definitely something that I either mention if I'm recommending a listing, if I'm featuring a listing, or I'll hold off until it's showed its hand before featuring a listing, because the primary responsibility that I feel is not featuring something that could cause a loss of capital. So I'm not willing to feature something unless I'm confident enough that it's looking a decent purchase. So yeah, I think that's the biggest way that investors can get burned. But I mean, other things are less critical. The kind of things that you do when you're working with investors on acquisitions. You look at backlink profile and how traffic is spread. These things can be better managed, but just make sure that you're not acquiring something that is trending down. I think is the biggest thing.
Yeah, it's a good point. So when we look at affiliate sites with organic traffic, generally, like we look at a bit of everything, of course, Ahrefs, SEMrush, like the external tools, and then looking at Google Analytics, at Google Search Console. So the main things, like you mentioned, would be the searching if there is a recent update, if there is something fishy going on. Like sometimes there would be some inconsistencies, and then you'll just be able to spot them immediately if something just doesn't add up. But in general, things like looking at the top traffic pages, sometimes you'd have all the traffic, like 80% of the traffic coming to one page. So that's not terrible. Yeah, it's like reasonable, especially for a small site. But it is something that might be a bit higher risk, like if that's one ranking that you are depending on. Especially if like that's a page that has all the backlinks coming to it, and all these backlinks are like lower risk, higher risk. So then of course we would look at the backlink profile also, and one of the recent trends, most up-to-date SEO method, I think, is to look at the top competitors, kind of evaluate their anchor. What's the exact term? Like the anchor proliferation, kind of like the percentage of their exact anchor versus like other anchors, and then like compare these kind of things on your backlink profile to see that it's not like a much spammier than the average competition. So kind of things like that.
For sure. Yeah, for sure.
And SEO has become quite technical. I think also a lot of people, especially first-time buyers, they might not realize that it's pretty technical. Like people would think that you just go and buy some backlinks and then you just go and add some more content and add some more articles. And unfortunately, a lot of SEO agencies still look at it just this way, just backlinks and content. But there's really a lot more that goes into like making a page rank.
Yeah, I think technical is huge. And it's not a skill that an investor will have if they are wanting to be involved in the website. And it's not something obvious either. If you don't know that something is not set up properly, you're not going to see it. Yeah. So having someone that can do technical SEO really well, or having an agency that provides that, I think is really critical. And it's so easy to mess up a site, even just doing a migration. It's so easy to screw up your traffic and not be able to get it back if you miss a redirect or something, redirect in terms of HTTPS or the subdomain to the root domain. If you miss something like this, I've seen six-figure assets, get destroyed just by missing this kind of thing. And so, I think the most upside that you're going to get if you outside of conversion rate optimization is probably in technical SEO. And, if outside of conversion rate optimization, outside of adding more content and adding more links, the upside is improving the technical SEO on the site or reducing the number of pages, like doing a content audit. If you're buying a website that has more than a few hundred pages, then before adding anything new, you need to audit the existing content, see which pages are bringing in very little traffic or have little to no links or any useful links, and look to remove those or rewrite those before you even consider adding more content. So it's a very technical space. It really is. I mean, content websites are the most simple business model when you compare to e-commerce or SaaS or anything. So, I mean, it is the most passive model possible, but you still need active involvement in order to maintain the cash flow coming in, and at the multiple that you acquired at. If you're acquiring at 30x, you want to get past 2.5 years cash flow to get your money back. Like, you need to maintain the revenue, and so that there is a lot to learn. You don't need to be the one doing it, but there is a lot that needs to be learned in terms of the primary components that you need to understand to maintain, to grow, and not to screw up a content site. And so with the publication, with the paid part there, I have standard operating procedures. I have about 10 of these processes for how I get upside out of content sites. What I used to do when I was the operator, and everything that you're doing. I mean, there's no magic to this. It's it's optimization, and so investors can follow that. But there's definitely a level of SEO knowledge that you need to have if you are not going to be paying for an operating company. And it
can be complex. Do you find that the beginning investors often follow these SOPs, and that they would often go and learn everything and learn up on all the technical SEO and do it themselves? Do you think that's like realistic?
No, I don't. I mean, I wouldn't do that myself. Like, I know basic technical SEO, but I'm definitely not an expert. If I had a big site that I thought could benefit from an audit, I would purchase one from an expert. I mean, SEO is too broad for one person to be an expert in all areas. Backlinking can be a career. Like technical SEO can be the thing that you need to focus on. Content optimization is a full-time thing if you want to be the best at it. So no, it's definitely not possible for an investor to. It's not feasible to try and get to an expert level, but you need to be able to understand where the opportunities are with the site that you're building, that you're looking to acquire, and be able to, know which suppliers or which operating companies are good to involve to do that for you. So you need to have that understanding of identifying what's currently broken, what the potential upside is, how you can achieve that. But no, if it's an investment that is complementing, you're bringing websites as an asset class that is part of a wider portfolio of assets, then it's kind of contrary to getting too involved in the operations. But you need to understand, what the game is. Just like if you're buying a property to rent out, you need to understand the area, the economics, the rental income that you can get, and what you need to do to fix a property up. You need to have the overall knowledge with websites in order to not get burnt if you are not hiring an operating company to run it for you.
Yeah, makes sense. Absolutely. We when we deal with investors, we usually make sure that they understand the basics, that they understand how the business works. Like even the most basic things, like how does it generate traffic? Because you have content that ranks in Google, and then what are the risks? So the biggest risk might be that you'd lose those rankings to Google Update or to a competitor, just kind of things like that, the basics. And I think just having that bird's eye view picture of what's happening, of how business operates, what are the main risks, the main opportunities, what is the potential growth, that's really important. And yeah, the technical SEO and the link building, that could be pretty difficult to do, and probably not required for most investors. But just understanding how it works is important. And then also, like being able to evaluate the risks in general is quite helpful. Just looking at Google Analytics is probably enough for most things, I think, because even looking at HRFs could be a little bit more intense.
Yeah, I mean, this is the thing. It's like, how active do you want to be when you are investing in these websites? Do you need to be the one that understands and can put your finger on where the risks are? Do you need to have your own Ahrefs description? Do you need to log in and check the backlink profile and look at the anchor text, or do you just need someone that is doing that initial kind of checking due diligence for you to set out the risks and the upside, and then you pull the trigger on that advice, or you have a company such as how you work with investors, where you offer that support and run the asset. So yeah, it really depends how involved you want to get, but just understanding. I think understanding, technical SEO, backlinks, what a natural looking anchor text profile is for the niche, and just a high level understanding of these things, I think is critical.
Yeah.
And whenever I was considering with the previous flipping websites business, I had a page where investors could apply to work with me. And on the initial phone call, I just spent it trying to put them off as much as I can, by saying, if this is the first purchase that they've ever done, by saying, do you realize that you could lose 80% of your traffic and revenue potentially within a month? Like, are you happy with this? Like, are you happy to have this potential, risk of loss? Because this is a portfolio play. Like, it doesn't make any sense for an investor to own one website. You have all your eggs in one basket. You need to really benefit from this and get a yield and get growth. You need to have ownership in a range of websites, in a portfolio, of a bucket. I think a fund is the natural extension of this space. It makes zero sense just to own one website unless you are, it's a capital amount that you're not afraid to lose, and you see it as something to learn and something interesting and a fun game. But if you're doing this to protect your capital and to get a return, then yeah, you need to be acquiring or having ownership in a larger number of assets. And at that point, you will need an operating company to manage them for you. So yeah, it's an interesting space for sure.
Yeah, that's what we've come up with as well. So that's the direction we've been going as well. So we have this one fund, and we are setting up a second fund currently. And we've seen that there is among investors also, there are many who are perfectly comfortable just owning one website.
Sure.
And I think that there are still ways. So I agree that it's definitely preferable to have multiple if you are looking at it as a more passive investment. But there are also ways to reduce risk, and also just like I think like making sure that you make a good deal, making sure that you spend a lot more effort on due diligence, and then like you mentioned as well, having a good management companies, having someone who's really good at SEO manage it, that would make a huge difference. And yeah,
if you're buying and you see clear upside, if you know that you can improve conversion rate and double the amount of revenue, or combine that with optimizing content or removing pages from the Google index, or any combination of things where you're confident that within a number of months you could be potentially doubling the revenue, then if traffic falls by half, assuming this math holds, it's a hot day here in the UK, you should at least be at even, right? But yes, I mean, content websites, the nature of the game is that you rank them in Google, you get organic traffic, and you rely on that. You can diversify, you can get social traffic going, you can get Pinterest, you can potentially run some ads to affiliate content that converts well. You can build an email list. I had a software review site where the email list actually drove the majority of the revenue. So there are ways to do that, but ultimately the flywheel is organic search, and Google can take that away from you. So if you know that and you're comfortable playing that game, then that's fine. But if you're investing any significant capital at where after a Google, and you haven't been hit by a Google update yet, and if that would be a bad thing in your life and make it would make a bad day, then that's not a good place to be. But yes, like a portfolio is the way that you protect against any one or two websites potentially being negatively hit, and also identifying enough upside definitely helps. But I mean, again, like if you bought an Amazon associate site back in early March, and traffic maintained the same through the May update, your revenue will already be half now because of the commission change in April. So there are ways to potentially protect traffic, or get it upside from traffic, or get upside from conversion rate. But there's also ways that affiliate programs, if you rely on Amazon, that there are ways that they can take that away from you. So again, understanding how websites generate revenue and how you can generate upside and potentially double an asset, and be able to flip that. That's a great thing to understand and a great experience to have. And if you're seeing it as an education as well as the high cash flow, then that's great. But you should definitely never rely on a consistent revenue level for years to come, which is why I think the revenue that multiples got way out of control. We were seeing multiples on brokerages and marketplaces starting with a 40x monthly multiple was starting to become the norm before the pandemic. And I just think that anything more than 2.5 years, maybe even 2 years for a content website is a little bit it kind of I'm not sure it's pricing the risk perfectly enough, especially with the Google updates seem to be more and more harsh. Like the November 8th one destroyed a lot of sites. The May 4th one destroyed a lot of sites. Obviously this traffic goes somewhere and some sites benefit, but I think, like identifying a site with upside, but also buying at a multiple that makes sense is just as critical, I think.
Yeah, I agree. Yeah, that's exactly how we fit things into our model of due diligence and looking at deals. So we have these 3 different parameters that we look at. Then we evaluate every deal. We look at the numbers, and that's of course the multiple, the revenue, the trends, and all these different things. And sometimes there are websites that are seasonal. Sometimes it's important to see where the industry is going. And then the opportunities to see what can be improved. And often that could be, finding more affiliate programs or signing up with higher value affiliate program, higher value monetization platform like Mediabuying or AdThrive. So, and the last one is looking at risks. So it's really important to understand the main risks and how to mitigate them.
Yeah, I mean, it's totally fine to pay, a huge multiple of revenue if the assets are undervalued or not priced in. If you see a deal that actually has a premium domain that isn't factored in, which is why I've started getting more into domaining. I find that really, really interesting. If a deal comes with a large email list that isn't being leveraged well, or if you could use that email list to drive revenue to another website in the same niche, or a website that is targeting the similar demographic, you may be able to leverage that and generate more total revenue. It's totally fine to overpay if you're able to, if you think the overall assets are undervalued. If the site is not generating, is very bad at converting traffic into revenue, then it's totally fine to pay a lot more. But I think just focusing on price to earnings, and I think going forward, the website investing space is going to get more sophisticated with valuations, and I think it's going to be more than just putting a multiple on the earnings. I think we're going to start looking at the value of the content and what that would cost to purchase, the value of the revenue. And I kind of see, I'd like to get to a place where we add up all of these different components. What is the domain name worth anything? Is the email list worth anything? Because there are platforms now where you can buy and sell YouTube channels, Instagram channels, and these things are not factored into to deals. It's just the revenue, and people assume that all of these individual assets, they're all driving the revenue, so they're already priced in. But I think what makes the most sense, what I'd like to see, is you add up, you place a value in all the individual assets, and then maybe on the revenue, you price that at 2 times, yearly revenue, not the crazy 3x or 4x that we were seeing, and then combine everything else together to get a more accurate valuation. So I think I'm starting to move away from just valuing purely on revenue or net income, because I don't think that makes the most sense in a space where there are far more valuable assets, digital assets, than just the website. So I don't know how I got onto that tangent, but yeah.
Yeah, I think it's a good point. I agree to some extent that the current market that's probably the biggest inefficiency in the current market, is that assets are not priced that well. The pricing is often based on multiple, but multiple and age and some of the other external factors, but it doesn't take into account the risk as much as it should. Like for example, you would often see a site that's maybe a year old, like less than a year old, and it has some pretty high risk SEO techniques, and it doesn't have any kind of moat, any kind of competitive advantage is just ranking in Google. There's no social, no newsletter or anything. And then you would see a site that's been around for like 5 years, 10 years, and has a newsletter, has popular channels, has a well-diversified traffic, and like 5 different sources of revenue. And the difference in price is maybe like 10% or 20%.
Yeah,
And
it's crazy.
to me, that's completely ridiculous. How can you? I think people have to put a much higher value on risk, because in the end, like if you're not going to make a profit, if you're going to lose money, it's not because it was not a well-aged domain, or it was not a premium domain. It's just because you misevaluated the risks. So I think like focusing more on that would also help people find really great deals.
I agree. And even, putting a value on the link profile.
Yeah, absolutely. Like
because people buy,
big one.
people buy domains for SEO from, the authority and the links that they have. So, rankings, traffic should have a value. Link profiles should have a value. The content should have a value. The domain should have a value. Other assets, email lists, social profiles, these should all have individual values, because they could potentially be sold separately, and they will start to be sold separately as marketplaces develop even more. And then revenue is something else that you then value or discount into the future. It doesn't make sense to
point. Yeah. I mean, it's if you are able to sell a Facebook channel and like a newsletter and your content separately, that would definitely make sense to value it. But like right now, I think it's really difficult to, let's say you buy a website that has a lot of high quality content, but then it's just not getting much traffic. So what are you going to do with the content? It doesn't seem like you have a way to sell it right now. Like maybe you can rank it, maybe you cannot.
Yeah, you can sell it as a starter site. So there is a category on Flipper for starter sites. And then there are lots of people selling starter sites, Human Proof Designs, Alpha Investors, heckup.com, hekkup.com, and a range of others who are selling starter sites, which is a domain, brand new or aged, plus content. And they're valuing the content typically at around 5 to 7, maybe even up to like 10 cents a word. That's how they're valuing the content. And these sites can come with, up to 100 pages and, 5-6K worth of content. So they are being valued, but then, when you get into these sites generating revenue, it makes no sense to me to then just completely disregard the value of the content.
Yeah, so I think it's limited. Like you would not, let's say you buy a site for $100,000, so you're not going to be able to recover. Like maybe you can recover like 2,000, like 5,000 at most from content, right?
If you lost all your traffic and revenue,
something like that. Yeah, it's like it's very limited potential.
It is. Which I mean the fact that you can potentially lose 80% of your traffic and 80% of your revenue if you're not able to improve that, within 1 to 3 months. We've all seen this countless times from a Google update. Means that this is a very high risk space. Now you would also argue that that's why you get your money back in 2.5 years compared to other assets, traditional businesses. Most other businesses are valued with higher multiples than that.
Yeah.
But like we said, it doesn't make sense to me to pay 3 years of revenue and assume that the site is going through 3 years of Google updates totally fine. So I think we need to come to a place where we actually discount future revenue and do more sophisticated valuations and add up all the different components and come up with a price, or just come up with our own valuations and not just go blindly on what a platform or a broker puts out as the market price. Because I think we were moving into a place where there was consensus that 40x, that that these assets, you can do them anywhere, you can buy them, you can work on them anywhere. There's real advantages over most other assets, especially, physical property or physical, brick and mortar businesses. So I understand that, but with content, and that makes sense with e-commerce, if you have your own brand, if you have a moat. But with most content sites, you don't have a moat. Someone can reproduce your content, do a better job, build more links, and take your traffic. And so there was consensus that, okay, multiples should be going up because these assets are awesome, and they are. But I think slapping 40x on revenue is way under pricing the risk, and there are better ways to do it going forward. And I think multiples for the rest of this year should be going down due to the pandemic. At least they've stopped rising from what I can see, which I think is a good thing. But we just need to be more sophisticated and better appreciate the other assets that are involved in website deals.
Yeah, absolutely. And on the positive side, the high volatility in the market, it's also benefiting all of us who are like more professional in that scene, because it just means that there is a higher difference between what would be a good deal and a bad deal. So that just means there is more opportunity to make profit, more opportunity to be able to bring value in the marketplaces.
Mm-hmm. Yep, I agree.
Cool. So what's next for you? You are doing this newsletter. Do you think you're gonna continue and grow that, like be in that, like fill that space of like educating and providing information for buyers, curating information? This
is my main focus, and it will be for years to come. The next 1 to 3 years. This is what I'm going to be doing. I like the fact that it's a media publishing play, and I really like the fact that it's there's no SEO involved at all. I'm not trying to get traffic from Google. I'm not trying to rank any of the posts on the publication. It's all for subscribers, and no one can take your subscribers away from you. No one can take page subscriptions away from you, and there are good opportunities for running advertising in the newsletter and the podcast. So monetization with this is really easy, and I view it as far more sustainable than any other business or content site that I've built previously. So I found a very good place to play in. I'm not sure whether I'm considering it as, I guess, a lot of people are subscribing to become educated about the space. I kind of see it more as like a news play, like a media play, and a curation play. I don't want to be, this is not going to turn into some kind of course, or I don't want to be seen as, I want to start removing myself as, as the expert. I want to make it more of a team play. I want to get other people involved. I want this to be able to build into something more sizable. And I guess education is a good term to use. I mean, domain investing has been around a lot longer than website investing. There's a lot of domain investing websites and publications and podcasts. Yeah. And this is kind of the first one focused on the website investing space, and just seeing how they have been doing things and copying, good parts of what they're doing. And so this is what I'm going to be doing for the foreseeable future. And it's a very scalable, anti-fragile business model for me, and in an industry that I'm still very fascinated by. But I don't want to be, it's not going to be, the Patey brand. That's how I kickstarted it. It's going to develop into more than just myself, and get other people involved, and get people who, my focus needs to be on the publication and understanding where the industry is going. I can't do that and be an expert operator. I want to connect with and interview the best people in the industry, I recently had the last podcast with Matt Diggity. It's hard to argue that anyone is better than him at what he does with SEO and website flipping. So I'm just going to keep connecting and building my network and bringing in the best people, and break down what they are doing and distilling that and just capturing as many valuable insights that I can that will make people looking to move into website investing more knowledgeable and more skilled at assessing risk and deploying capital into the space. So this space is continuing to grow. It's still, a large part of it is still Wild West days, but it's a great place to be. And this is my main focus for the foreseeable future, as long as it doesn't burn me out and kill me first. But I'm already looking to conversations with a couple of people, get them involved with writing and curating and deals. So I'm in a good spot.
Well, that sounds good. Glad to see that you found your spot. Well, thanks for joining us for this conversation. Good to chat. And so tell us, how can people reach out to you? How can people contact you and learn more about your newsletter?
Sure. Easiest way to get to the publication is websiteinvesting.co. It redirects to a subdomain that's on the platform called Substack. It redirects to patey.substack.co, Patey being my surname. I will change that at some point. I have been thinking about trying to buy websiteinvesting.com, but the guy wants 5K, which seems too high to me. But also, as this space develops and as my interest in domaining increases, I think we're going to start seeing this as wider than just a content site. There's a big widening of digital assets going forward. I think we're going to see this more and more. So I'm going to be involved in digital assets for the foreseeable future. Maybe you could even count crypto in that, which I'm interested in as well. But right now it's called Website Investing Publication. That may change in the future. But this is the space that I'm covering. So websiteinvesting.co is the best place to reach out to me. I've got a personal website as well, but that would be the best place.
Well, thank you. Have a good day, Richard.
Thank you. Cheers, Michael. Appreciate it.
Domain Magnet is a leader in buying and selling online businesses with a proven track record of expertise gained from over 300 deals since 2004. To learn more about how we can help you acquire or exit a profitable online business today, head over to domainmagnet.com for more details.